Market historian Jeremy Grantham has issued a severe diagnosis for the U.S. stock market. Driven by artificial intelligence hype, he warns that we are currently operating in the terminal phase of a multi-asset super bubble. The math behind his warning points to a steep drop. If the broad U.S. equity market simply reverts to its long-term inflation-adjusted trendline, Grantham projects a potential decline of up to 70%. He argues the structural fragility in today's financial system mirrors the setup right before the 1929 market collapse. When valuations detach entirely from underlying economic output, history suggests the eventual correction is violent. This chart plots the S&P 500 Shiller CAPE ratio over the last century. The historical average is roughly 17. Today it sits near 40, exceeded only by the dot-com bubble. Market concentration is equally stretched. Just 7 tech companies now absorb roughly 35% of the total S&P 500. While AI represents genuine technological progress, the financial infrastructure built around it relies on hundreds of billions in capital expenditures. Much of that spending is unproven against consumer demand, creating massive pressure for these companies to deliver immediate profits to justify the build-out. The macroeconomic data shows a historically expensive U.S. market. Yet panic selling an entire portfolio based on a single vulnerability often creates more risk. Grantham identifies asset bubbles with historic accuracy, but he consistently fails to time their eventual collapse. He accurately called the 1989 Japanese asset collapse and the 2007 housing crash, but he also turned bearish on U.S. equities in the mid-1990s and again throughout the 2010s, years before the markets actually peaked. This line graph tracks the S&P 500 from 2010 to today. If we drop marker pens every time Grantham issued a warning to exit the market, his calls contrast sharply with the actual upward performance. An investor who liquidated to cash in 2010 missed hundreds of % in compounding growth. Being early and wrong produced the same result. Sitting in cash while peers profit year after year creates intense tracking error regret. This psychological pressure often leads investors to abandon their defensive strategy and buy back into the market at the worst possible time. Most institutional wealth managers avoid discussing these risks because their revenue depends on keeping your assets invested. AUM-based fee models create a structural incentive to stay bullish, even when valuations suggest extreme danger. Building a portfolio that survives a sudden break while staying positioned for another decade of potential AI growth remains the central challenge. One option is the most extreme pillar of Grantham's playbook, completely divesting from broad U.S. equities and mega-cap tech stocks. Holding 0 U.S. stocks mathematically eliminates your exposure to a 2000-style mean reversion crash. You effectively remove yourself from the bubble's blast radius. But a binary move to cash creates a different vulnerability. If AI corporate margins expand and fundamentals justify today's prices, sitting on the sidelines results in a permanent loss of purchasing power relative to the rest of the market. To maintain equity growth without U.S. tech risk, Grantham recommends reallocating capital into non-U.S. developed markets, like Europe and Japan, and emerging market value stocks. This chart shows a clear starting advantage. European and Japanese equities trade at significantly lower price-to-earnings multiples than the U.S. These valuations drive GMO's 7-year forecast, projecting a nearly 8% annual loss for U.S. large caps, while international value stocks show positive growth. However, international markets face their own headwinds. Many lack the technological innovation of the U.S. and suffer from demographic decline. These markets can remain statistically cheap for decades without ever delivering the expected breakout. Moving an entire portfolio from the U.S. into international markets swaps one concentration risk for another, trading potential overvaluation for years of possible stagnation. Beyond stocks, traditional portfolio theory relies on wholesome bonds to act as a safety net during a crash. High-quality U.S. Treasuries and investment-grade corporate debt currently offer yields between 4.5% and 5%. Instructive, during a deflationary crash, bonds provide defensive ballast. When a recession hits and central banks cut interest rates, existing bond prices typically surge. This capital appreciation helps offset the losses in your stock portfolio. But bonds fail when the crash is triggered by an inflation shock. As we saw in 2022, rising inflation forces central banks to hike rates, causing stocks and bonds to decline simultaneously. To hedge against that risk, Grantham suggests dedicating 5 to 10% of a portfolio to physical precious metals as insurance against fiat debasement. Gold functions as a non-correlated asset with zero counterparty risk. When geopolitical stress or aggressive money printing dilutes the value of currency, gold often revalues upward to reflect the increased supply of fiat money. Gold is an insurance policy, not a compounding machine. It produces no yield or cash flow, and it historically endures multi-decade periods where it provides no real return after inflation. Combining these defensive assets into a single strategy creates a safety net where individual vulnerabilities offset one another, matching your long-term investment horizon. By moving away from binary all-in or all-out choices, investors can adopt a strategy of calculated tilts that account for bubble risk. This table maps Grantham's defensive assets to 3 specific investor profiles and their respective life cycles. Profile 1 is the capital preserver, typically a near retiree. Their strict Grantham allocation prioritizes absolute wealth protection, utilizing only 0 to 5% in U.S. equities, a heavy weighting in international value, and a 40% allocation to high-quality bonds. Profile 2 is the Pragmatic Optimizer, suited for mid-career investors. Their balanced hedge reduces U.S. tech concentration while maintaining a growth core, using 20% U.S. value, 30% international exposure, and a 25% fixed income safety net. Profile 3 is the Horizon Maximizer. Younger investors maintain a heavy 40% U.S. exposure to capture long-term growth, but they use a 15% bond and gold sleeve as dry powder to buy into future market dips. Cryptocurrency is absent from these models due to its speculative nature. Because it lacks intrinsic cash flow, any Bitcoin holding should be restricted to a small 0 to 3% sleeve if they are held at all. The most effective implementation involves writing down these allocation rules today and rebalancing gradually over several months. This disciplined approach prevents emotional, panic-driven decisions when headlines turn negative. A customized portfolio survives a bubble burst while staying solvent if the crash never arrives, effectively decoupling your financial future from the impossible task of market timing.